Okay, perfect. So yes, I was going to introduce myself. I'm a licensed financial advisor. I also have a background in accounting and finance, the international standard ACCA. I also happened to work with a bank, one of the big banks in Nigeria before coming over to Canada. So I'm pretty excited when it comes to numbers because they say a whole lot. They can tell you the entire story about either the economy or the organization or even the various households within the organization. So numbers tell you a lot. And like they say, numbers don't lie. If you feel you're wealthy and you're owing, if you check your bank account and you're owing everybody and there's nothing in there to show for it, definitely it's just in your thoughts, right? Numbers will tell us the situation as it is at any point in time. So I'm always excited about numbers. Um, we'll keep this session as brief as possible because I know everybody would also want to go back to enjoying their weekends. But beyond keeping it brief, we'll try to make it interactive and as impactful as possible. So I know we have a number of people on the line, a number of us I know personally, but by way of just interacting with us as we open this session, um, I'd like us to quickly run a poll. I'll share the link in the chat in a bit. I want us to run a poll to basically tell me one thing that you'd like to learn from the session. Of course, I have slides prepared already. Hopefully, you're going to tell me all the things that are on the slides are the things that you're looking forward to learn. But I'd like to know just one thing that you'd like to learn from today's session. I'll share a link right now so that everybody can vote and we can see everything on screen in real time. Where is the chat? Okay, so I've shared the Slido link. Click on the link, it's going to take you to a portal where you can submit that one thing that you want to learn from today's session. And let me also share the screen where we would aggregate the results. Someone came in very early and dropped budgeting. Please, can you all still see my screen?
Yes.
Okay, thank you very much. So someone else said wealth building. So we can see what each of us are submitting anonymously. So I like this platform. You can see it in real time. Budgeting, wealth building, financial literacy, building wealth through investments, making money. I like the simplicity of that. Let's make money. Stock purchase using Wealth Simple. Okay. What else? We have 6 votes now. What else would you like to see? We have 10 people on the call. I think that's inclusive of myself. So I'm hoping to see at least 9 votes. We have 6 already. So we're expecting 3 more votes based on the number of the people on the call right now. 3 more votes. 3 more votes. Welcome, Mr. Gbenga. Thank you for making the meeting.
Yeah,
Um,
sorry for coming late.
no, why? It's not a military regime. We appreciate you for making the time. So the question is on the screen. I just started the session right now, and we're saying, what's that one thing you want to learn from today's session? So I want this to be very valuable for each and every one of us. So just one thing that you'd like to learn from today's session, and I'll do my very best to attend to all these things as much as time permits. If there's no time, we'll book another time. So it's fine. So we have 1, 2, 3, 4, 5, 6. We have, I believe, 9 people on the call. So we're expecting 3 more votes. What is that one thing you'd like to take away from today's session? Now we have 10 people waiting for 4 more votes. We're giving us about 30 seconds so that we can carry on with the rest of the session. Investments, stock purchase using Wealth Simple, wealth building, making money, financial literacy. That financial literacy is very broad. We'll do our best to attend to it. Building wealth through investments. Sorry, everyone, I have a little bit of cold, but I'll manage. Okay, so we'll get back to this list. And like I said, I'll try to attend to each and every one of them. Welcome, everybody, as you joining the call. Welcome, welcome. Now let's get to it. We'll be looking at two things, essentially. The first one is the money game. It's a Saturday, so I just figured, you know what, let's keep it light. We'll make it educational, but at the same time, we'll make it quite light. So no big grammar, no strange words, financial terms, and all that. I don't want to turn everybody into accountants. The whole goal, like I said, is to make sure that we're better with our finances, even as we try to save as much as possible or build as much wealth during these uncertain times, uncertain political environments that we're in. So we'll look at the money game, and in a short while, we'll see what that entails. Then secondly, we'll see how to win that money game consistently. Then we'll go into the Q&A session. So let's jump right into it. The best thing to call this is actually the money game, because until you get to the point where you can play with money, you're not truly independent. In most cases, of course, I know we've all experienced it. Money is a big part of our lives. And if you're not careful, money will, either you accept it or not, rule your life, meaning it's going to dictate when you sleep, when you're available to your family, when you can go on vacation, you need to take permissions and all that because you need to be in attendance, especially at a place where your wages can be paid. So if you don't figure out how to really play the game will actually play you. So that's the whole concept behind it. And there are some major players in the money game. It's all about economics. One of them is the producer. So the producer is basically the organizations, the companies, the places where we work. Those are the guys that generate the revenue within the economy. Almost everybody else depends on them. So they are the ones that take the raw materials in whatever shape and form and transform it into valuable resources. And we'll go a little bit deeper into each of these characters in a bit. The other one is the bank. I call them the magician. I'll explain it in a little bit as well. The other entity is the consumer. And I believe most of us on the call, either partly or in a full-time instance, are consumers. You definitely eat food, you buy stuff from the stores and all that. And we'll see the characteristics of that character or persona in a bit. Then the final one is the government. Now, why are these guys the key players within the economy? Everything that happens determining how much you make, how much you save, how much you keep, how much wealth you build, if you're going to be comfortable within the economy or not, if you're going to thrive. All these guys, in some shape or form, will determine that fortune for you. So if you're aware of them, if you know exactly how they operate, then of course it's easy for you to engage them appropriately so that you're not outplayed. Now, starting from the upper left-hand section, when we're talking about the producers, like I said, they manufacture everything. They are the ones that really generate the revenue. So we all look up to them to continue to perform. If they do their jobs very well, then of course, not only will they make profits for themselves, the profits will be able to pay salaries to the consumers, which are employers within that those organizations. But beyond making that money and paying employers, there's also the stock market that they create. And the stock market is a very big driver of every economy. Now, just to quickly explain what that means, the stock market. All the organizations within the economy have some kind of value. So they are either privately held or publicly listed. What that simply means is you can run your organization and decide to borrow money from where you know to borrow money or use your personal capital and run your business. Or you can say, you know what, everybody on this call, you can chip into $2 into my organization. And if I make money, I'm going to give you some amount of money in return. Now, that amount of money that I'll give you can come in the sense of dividends or stock appreciation, meaning if you buy one share in my company today, and you bought it at $2. Tomorrow, because I continue to perform very well, tomorrow that share price might have gone up to like $5. So that means you've gained $3. So they continue to create value for the economy that we all consume. They also continue to create resources that is redistributed through payments to employees, and also intrinsic value in goodwill, in stock appreciation, and in so many ways. So that's why I say they definitely drive the economy to a very large extent. Below them are the banks, and I call them the magician. Multiplier, by the way, for producers is exactly like I explained. They take in raw materials, transform it into something very beautiful, magical, and value adding, and then pass it along. Why I called banks the magicians is there are several concepts that go on within the bank that a lot of us are not privy to. Maybe if I hadn't studied a little bit of accounting and finance, I also wouldn't be privy to it. Now, when I was putting this together, I wanted to make sure that at least we learn one thing that we did not know before, at least one thing. And I believe this particular concept I'm about to mention is one of those things that you probably might not have heard about before or understood fully well. There's something called fractional reserve system in the banking industry. And it basically means if I work for an employer, I get $10 and I take my $10 to the bank. The bank will take it as deposit, but of course, they need to make that money, they need to multiply that money or invest it so that they can earn interest and pay their staff, pay me a little bit of interest and all that. The way they do it is they're expected to keep a fraction of that money, which is why you call it fractional reserve system. Now, this applies to most banks all around the world, not just in Canada. If I put in $10, by law, most economies would require them to keep $1. On my mobile banking app, I'll see $10 there. But the actual fact is in the bank, you don't have $10. Only have $1 in cash. But on your mobile banking app and all the other portals, you see $10 there. They'll reserve whatever that proportion is. So if it is 10% of $10, that's $1. And loan out the entire $9 that is left. How does that make them magicians? If I put in $10 right now, today, I have an account balance of $10 and I go back to that same bank, I can tell them to give me a credit card. And it's even very interesting in Canada. They will give you a credit card that is multiples of the amount of money you have in the bank. So I have $10 in the bank, cash. I collect a credit card of $1,500. Instantly, I can buy something that is like 150x the amount of money I have in the bank. So that is creating almost like creating money out of thin air. That's what banks do. And that's why they continue to thrive because they have that power to conjure money out of nowhere. There are a lot of complicated systems underlying these risk management systems to make sure that they continue not to lose every time, or at least not to lose as many times as they win on that bet, because it is a bet. If you give me a credit card of $150 or $1,500 and my cash balance is just $10, there's a huge risk that I might not be able to pay back. But basically, that's how banks operate, and they know how to manage that risk. So that's why I call them the magician. They can actually conjure money out of nowhere. Now, they also do the general traditional thing, aggregate all your deposits and loan it to the producer. We'll see more about that in a bit. In Canada, that fractional reserve system does not require them to retain any amount of money. So it's just silent. That's what the regulation says on it, nothing. So it simply means if I deposit $10 in the bank, legally, the bank can actually loan out my entire $10. I think in Nigeria at some point it was maybe 30% or something. They actually have liquidity ratios and all that to make sure that you have a fraction of the money actually present in the bank. But in Canada, they can lend out all your money. Now, what's the implication of that right now that we are attending to it? It simply means if you decide your money is safe or you assume that it is safe, you want to keep it in the bank, and of course, you don't want to risk your money, the bank will risk your money for you. And of course, they will make tons and tons of money on it. And the last time I checked, the interest rate on savings is like maybe 1.6% or if not less than 1% right now, of which they can clear out 20% or whatever the profit is on the same money you put in there. They don't have to keep your money idle. So that's the magician. Then, of course, you go to the giver. That's the consumer. I call them the giver because they give both their time and their money. That's the consumers. So you typically go there to work. You work in your 9 to 5. Thank you for joining. For everybody just joining, I shared a link. in the chat. Please, if you see it, you can answer the question on the Slido frame. It basically says that you should tell us one thing that you want to learn from today's session. I can reshare the link in case you can't see it. So I believe everybody can see it again. So if you voted before, just ignore the Slido link. But for everybody just joining, please vote on the Slido page so that we can see one thing that you want to learn from today's session. Once you click on that link, it will allow you populate this page, and we'll get back to it later. So the giver will be the employer, of course, and you exchange time for money. Apart from exchanging time for money, you also still give that money out. And here's what I mean. So a typical consumer who is nothing else, like we'll talk about hybrid characters where you are a consumer and you're also an investor and all that later. But just to understand the individual concepts, let's assume that a person is just purely a consumer. You will give your time in exchange for money, but when that money comes as well, there's a very high tendency to lose that money inadvertently. So the most obvious one would be through taxes, right? So you pay taxes to the government. The second one that is not as obvious is through the various interest rates that you pay on your cards and all that. The third one that is most silent is inflation. Again, we'll delve a little bit deeper into all those components. But the point is the giver gives time, gets money, then instead of appreciating the money because time is priceless, when you give that time, you can't take it back. The number of years you spent with that organization, you cannot get it back. So the money that you got in exchange should be precious, but you are not even able to retain it by the very nature of money. You tend to lose it in terms of taxes, inflation, and interest rates, right? So we'll get deeper into that. Now, knowing all these key players, the producer, who I call the multiplier, the government, I will explain the government in a bit, who I call the balancer, the bank, the magicians. And of course, if you have any questions, you can type it in the chat session, or please, you can note it down, and I'll address them at the end of this quick presentation. So you have the giver who is the consumer. Then you have the balancer. I call the government the balancer because in most cases, when the government interacts with the economy, they talk about budgets. And the target of the government should be to achieve a balanced budget, or if fortune smiles on them, a surplus budget. What that simply means is the income or the revenue of the government should be the same thing as the expenses, as a net zero position. But if the income is much more than the expenses, then that's a very good thing because now they have a surplus budget, meaning they have excess money that they can reinvest back into the economy. But the main target is to make sure that at least they are not losing money. They achieve a net zero position. So they are the balancer. And in economies like Canada, Canada operates a mixed economy. What that means is it's not purely capitalist and it's not purely socialist. It has traits of both aspects, meaning they have a stock market. Stock market basically is where you can make as much money as you want, as long as you know what you're doing in there. Then the socialist elements of the economy is the fact that we have free health system and several other welfare infrastructure within the economy, right? So they make sure that all that wealth is aggregated through collection of taxes, then redistributed to the population. So they just try to keep everything in check and balance, provide security for the entire population, take care of all the create policies that will make the organizations within the economy thrive and all that. Just make sure that all the parts within the economy are running smoothly. Now, how do these players interact with one another? That's the next interesting thing that would start to uncover. The producer creates a lot of value. So out of that value, they pay taxes, they pay salaries, they pay interest back to the bank. And because of the kind of power they hold within the economy, the government who creates all the policies recognizes them. So they favor the producers the most within the economy. So when they're creating policies, they want to make sure that the GDP of the economy continues to increase, for example. If you hear about GDP, which is gross domestic product, it simply means the quantity of activities within the economy, how much buying and selling you have, how much salaries were being earned, how much goods were being produced, and all those things. So those things are indicators of how well an economy is performing, right? So the government would create all their policies to make sure that the producers, the companies, the organizations can thrive. So everything tends to favor them. So they get all the facilities, they get all the tax cuts and all that. And then, of course, out of whatever they make, they do distributions. Part of the power they hold is they can almost perpetually hold on to capital or continue to expand their capital indefinitely. What I mean is this. So you have an organization that takes a loan from a bank and buys like two additional offices. As long as you don't sell those offices, by the way, continue to appreciate in value, right? They bought it at 500K. 10 years down the line, it's now 1.5 million. As long as they hold on to that property, they do not need to pay tax. And their value is increasing. And like I said earlier on, all those things impact on the share price and every other thing that ties into them. So they can indefinitely continue to expand their value. The reason I'm painting that picture very clearly is because the best position, if you ask me to hold within any economy, will be to become a producer. So some of the questions I hope we'll be going away with from this workshop is how exactly do I become a producer? Because they hold a lot of power. We can book a separate session. I can get into both the technical and the soft parts of it. It's really interesting. It's exciting. If you ask almost any entrepreneur, that's why their lives are exciting, apart from the travels and all that. You just get to solve a lot of problems, and of course you control a whole lot of assets and cash, and you some worries are not just your problem. If there's a tariff, probably okay, yeah, it might impact on you either in the short term or in the long term, but you have so much leverage that you can decide to move your operations maybe offshore or decide to get tax cuts from the government. There are so many options, but imagine if you were to be just a consumer, purely a consumer. In most cases, consumers are the one that bear the brunt of the economy. For example, there's this tax tariff that was levied on Canada recently, and then there was a reciprocal. Part of the effect, and this is not even hypothetical. I spoke with, incidentally, some of my friends, both in the United States and in Ontario here in Canada. People are losing their jobs already. So if you were just to be a pure consumer, you're just earning salaries, then buying house, buying car, and you're not spending so much time saving and investing. The people that are hurt the most during any economic turmoil are the consumers because there's no fallback. But for the producers, some of them are so big that the governments can afford them to fail. For example, we have five major banks in Canada, 5 or 5.5, depending on who you ask. TD is one of them. TD's net assets is over $1 trillion. If TD coughs, recently TD was involved in a fraudulent situation in the United States. They'll probably just sanction them and levy them some amount of money and let them carry on with business. But there's a limit to what you can do to organizations that grow that big. So they get a lot of leeway within the economy. They hold a whole lot of power. Now, is that good or bad? That's a separate conversation for another day. So this is an enviable position to hold, and anybody can hold the position of a producer. Anybody. There are so many pathways to becoming a producer. And we'll get back to that in a bit. The government does one thing very well. And of course, I believe we already know it. They collect taxes very efficiently, especially in economies that are developed and they have the structures for it. So they collect taxes from the consumers, from the banks, from the producer. Everybody pays them taxes. And you can't blame them. It's normal. They use the taxes to provide infrastructure and every other need that the country needs to work efficiently. Out of these three guys paying taxes, once again, the consumer suffers a whole lot. The consumer will pay taxes by at source when you're getting your salary. Then by the time you go to Walmart, you pay another taxes, HST, GST, PST, and all those things. By the way, payroll taxes are like maybe four, if not more. I think we have HR professionals on the call. They'll be able to spell out all the many taxes that are not called taxes on the payroll, right? So you pay all that upfront, then you take the money that is left with you called take home pay, which does not get home actually. You take it to the store, you pay another level of tax in there. Then after you're done with that, okay, you have like maybe some dollars left. You decide to put it into some investments. If you make money from that investment, that one too gets taxed. So that is just one steady stream of money, just the same steady stream of money getting taxed at least three times. And that's not the end of it, of course. If you buy a house, you pay property tax out of the money you take home. If you buy fuel, you pay fuel tax, even though, once again, it's most likely not called fuel tax on the face of your receipt. So you have all that happening to the consumer. But in the same instance, for example, while we're on this page, if either the bank itself, the banking hall, or the producer, any other organization decides to spend money on diesel to run their generators or any other expenses, they are allowed as long as those expenses, they call it reasonable and normal in the carrying on of your business. As long as you can justify it to be linked to your business, you can make it a deductible business expense, meaning you are going to take it out of the income before you pay tax, meaning you are going to pay less taxes compared to an entity that is not a bank or a producer. So that's the government, they collect all those taxes, and guys that pay the most of the taxes are the consumers. If you check the breakdown of the revenue of any economy in most cases, except for the places where they don't collect so much income taxes, like I believe Saudi Arabia and a few other countries, most economies actually depend a lot on the income taxes collected from consumers. And it makes sense. In most economies, you will see that you have more population, that is more human beings, more people work available to work or working. The workforce is larger than the number of organizations. So if you're comparing income tax to corporate tax, it's most likely you would have more coming from income taxes. Because also remember that if you run your thing on a solo, like you're not working, you're self-employed, you will still pay taxes. You're expected to pay. In fact, in Canada, it's called global income. That is money you make from everywhere in the world, maybe including the ones that you even make from out of space. And I'm not even joking. If you make money from out of space and you're a Canadian resident, normally they will expect you to declare it and pay taxes on it. So moving on quickly from the government, we come to the bank. I won't dwell so much on this. I already explained fractional reserve system and how they can almost create money out of thin air. And of course, because they have a lot of money, they continue to have a lot of money. You will fully give your money to them, the $10 I described earlier, and they are not required by law. The fractional reserve system in Canada does not require them to keep a certain percentage, although they have several other risk management guidelines and all that. But when it comes to specific percentages, I couldn't find any in my research. So it means they take all those deposits, multiply it or clone it by creating like 10 times of that money, then pass it out in form of corporate bonds, pass it out in form of credits, consumer credits, mortgages, and every other thing, and loans to producers, and then continue to grow that money. So banks, if I were to rank them, I definitely would want to either be a producer or a bank. But at some point during this slide, we'll be able to pick our favorite player in this money game. So banks continue to give more and more money because they have it. Then you have the consumer. We already explained the consumer bears the brunt of everything. Pay tax to the government, pay expenses back to the producer. And in case you're wondering why expenses is going from consumer to producer, it's because you go to almost everywhere. You buy tires for your cars, you pay it. It's called maintenance and expenses for your car. You go to Walmart, same thing, grocery expenses. So all the companies that you deal with will take money from you, and to you on your own books, it's called expenses. To them, it's called income or revenue. So that continues to go on. Net asset is painted in red in there because again, when I was putting this together, there are several interactions that the consumer would have with the bank. So you collect your $10 again from wherever you earn the money from, either self-employed or working with a company, and you take that $10 to the bank. And the bank says, well, you've been very loyal with your credit card. You're using it and you're paying back. If you're ready to get a mortgage, we'll give it to you. Then you get a mortgage of $1 million on a salary of $25,000 per annum. They will, if you can justify it, you have child benefit and all that, and you combine with your husband or your spouse, and it is possible for you to get a whole lot more than you ordinarily can afford. So you get all that. Remember, your bank deposit is still $10. And now you owe the bank a whole lot of money, way beyond what you have in the bank. So a lot of people quickly get into that rut. To paint that picture clearly for us, the debt load of Canada, as at a few weeks ago that I checked, was $2.6 trillion. 2.6 trillion. If you break that down into a household of the average of four, that would be $280,000 per family of four. If you break it down to individual, that would be $70,000 per individual. That's average debt. And as we would expect, what makes that number so big is mostly the mortgage. Mortgage takes maybe about 20% of all of those facilities. Then, of course, you have a huge chunk in consumer credit. That's your auto loan, all kind of soft loans, line of credit, grants that you pay back, all those things make up the rest of the money. But the point is, on the average, meaning you're counting 1 year old baby, 2 years old baby that knows nothing about all these things. If you redistribute the money that we owe, the 2.56 trillion, then of course each person will get a share of $70,000. So we owe a whole lot, way more than we have in the bank. So those are the players, right? Now, quickly, who would you like to be out of these four players within the economy? The government, the producer, the bank, or the consumer? You can use the same Slido link to vote on the screen. So let's use the same word cloud. Use the same Slido link. I'll share the word cloud. Okay. So if you can vote, tell me which one would you like to be? Producer, I see producer. So you have four characters: producer, bank, consumer, and government. Maybe you want to support Trump in his regime. So I see one producer. We have how many people on the call? I know we have more than 10 people here. One producer. Okay. Let's carry on. We'll come back. Um, so the second half of it, or before I go to the second half of it, of course, like I said, if you ask me to pick, I definitely will pick the producer because the economy favors the producer. You have a lot of leeway, you have a lot of deductible expenses, you pay, you can manage how much you pay in taxes. But if you're a consumer, you can't decide how much you pay when you go to Walmart, and you can't decide how much your employer is going to take out of your paycheck. So and when we say producer, right, I keep mentioning companies, but it goes beyond that. So you have self-employed people in there, you have investors, you have business owners. When someone or an entity is called a producer, basically it simply means you can take either money or asset and put it to work to use it to build more and more assets. So you can grow either money or any other form of asset. And of course, when I say asset, specifying it different from money, assets could actually mean a building, right? It could be a commercial property, a rental property, an office building, or anything that basically, one, appreciates in value typically, although that's not the indicator for defining assets in accounting terms, but more importantly, that can help you generate more money. So you can, if you can take that and transform it and continue to grow it, then you are a producer. So it could be one just doing a side hustle as a barber, and of course you get paid for it. Of course, that means you've created value within the economy. You've added to the GDP. You are a producer. So it can be any business at all, anyone. It can be a freelance that you do on weekends, and it just earns you a moderate amount of maybe $100 here and there. You are definitely a producer. You can scale that up into anything. Amazon did not start up to be a multi-billion-dollar company that it is today. It started from very humble beginnings, right? So that's about the money game and the most interesting people to actually aspire to be in the game, the players, of course, the producer, and also if you can be the bank. Banks mainly just manage risk, like I mentioned earlier. They don't have to worry about where the money will come from. You will willingly give your money to them. That's how they are positioned within the economy. They are just so they've worked their magic so perfectly that we are always attracted to them like flies. Like I'm very sure my money will be safe with the bank. It's a mirage, but we're not we're not going to spend too much time on it today. Then, of course, banks rely on insurance companies. Banks have a huge amount of insurance assets within their portfolio. And the whole idea of it is to make sure that out of all their portfolio of things that they're investing, they want to keep a portion of it safe. So in case anything rocks the bank, they can rely on less risky assets to cover the gap. So they have huge amounts of insurance assets in banks. And that's part of the ways in which they manage risk. So if you aspire to be a bank, it's just basically to understand how all these things work and apply to your own money. So like I said, it's a mirage thinking your money is safe with the bank. They are risking your money on a daily basis. So if you have enough knowledge and know-how of how you can multiply your money by yourself, you can bypass the middleman, because essentially the bank is an aggregator. That's what they do in the economy. They soak up all those deposits from you and I, then redistribute it to places where those money can work and bring them interest. If you can do that with your own money yourself, you just skip that middleman, skip all the fees that you pay to them, take your money to where it will work, manage your risk effectively, build your assets, do the necessary insurance that you need to do, and you're fine. It's not even complicated. Well, again, maybe because of what I know about numbers, but it's not particularly complicated. Anybody can do any of these things. And if you have any questions at any point in time, of course, please note them. We're almost done with the session. We'll just go through the next part, then we'll take questions. Now, more importantly than the players within the economy, now you know the game. You know the key players: producer, bank, consumer, and government. We have several other players too. I said key players, right? So you have environmentalists, making sure that you don't pollute the climate too much. You have what do you call them? You have a lot of participants basically within the ecosystem, because you have lobbyists, you have politicians alongside the government, you have NGOs. Yeah, that's the one I was trying to remember. Not either non-governmental organizations or non-profit organizations, whichever one. So basically, they are not in there for the profit, but they continue to create value within the economy. Again, we'll pack that for some other time we have time. But there are several other players, but these four are the very, very active players within any economy, and they can make or crash the economy. We can talk about the tariff later as well. Now that we've exposed the main players, you can ask me anything about how the tariff impacts on any one of those players and all that. Now, like I said, more importantly, now that we know about the money game, how can we play the game to our advantage? How can we play this game to our advantage? Number one is to know how much is sufficient for you as an individual. Some wise man once defined greed as anything that we aspire to get beyond our need. So the first thing is to know how much you need. Anything in excess of your need, if you don't get it, it's fine. You'll still be okay because you have your need, right? So it's to know how much exactly do you need. And it will vary from person to person. We don't have the same size of family. We don't have the same aspirations. We don't have the same size of houses. We don't have the same ambitions. So your need would actually vary from person to person or family to family. But you need to establish what that number is. At the end of the day, if you can pen down the number, it is $500,000, it is $200,000, it is $1 trillion. Now you can work towards it. If you cannot pen down that number, then it continues to be a mirage. Then, for example, I listened to a lot of podcasts, by the way, financial podcasts and several things. So there was this very wealthy man in Africa who kept working. He was already in employment for about 23 years, he was an executive and all that. But he kept working for one reason, even till he was maybe in his late 50s. He was scared because, of course, the juicy salary was always coming in. He had a huge amount of expenses, but he was not so sure if he would be able to maintain that lifestyle if he retires or if he resigns. So he just kept working. It wasn't convenient for him. His health was deteriorating, but he kept working. Why? Because he did not know what his number was. Now, he was fortunate to meet one financial advisor. I think the guy is in Kenya. Both of them were in Kenya. So he met the financial advisor, and the guy was able to help him analyze his budget. This is your income from all sources, all your assets, all your investments, and your salary all put together. These are all your expenses, these are all your exposures, and all that. And he realized that the net worth that he had accumulated at that point in time, If he banked it in a safe asset, meaning maybe he buys a GIC of 3% or 4%, he will be able to live on that money for the rest of his life. So the reason why you might be caught up in a job that you don't like, or in a hustle that you don't like, or in a lifestyle that you don't really appreciate, is the fact that you don't know your number. Once you know your number, it's easy to work towards it. And when you hit that number, it is now a choice to decide, do you continue to work, or do you want to go and do the things that you really love? If you love charity, you do it. If you love the work of God, you can focus on it. If you love spending time with your family, you can focus on it. Because time, like I mentioned briefly earlier on, cannot be retraced. Once it is gone, it's gone. Once you don't realize it at 50, no wala. You get to 60, you still don't realize it. That 10 years that you've wasted not knowing what you should know, you cannot get it back. So the earliest time possible that you should know your financial independence number or your needs is today. And I'll tell you exactly how to calculate it. So in some circles, it's called financial independence number. It simply means how much money do you need to have that will cover all your expenses, and then you do not have to work anymore. Now, I say you do not have to work. I don't mean you must resign. You can decide, oh, I still love what I do, right? So you can still continue working. But you have the option to say you want to resign or you don't want to resign. You have that freedom. You know that you're not caught up in the rat race. It's just by choice that you're there, right? So what's that number? How do you calculate it? First, you need to know what your expenses are. That's the easiest way. There are several formulas to it, but the easiest one will be to know what your expenses are. So let's say you are in a stable position. You bought your house, your mortgage is 2.5, your car loan is X amount and all that and all that. Your groceries is X. You put it all together in a month, you're spending, let's say, maybe 3,000 something. And you grade that, you pull that together in the year, it comes to 50,000 per year. That's how much you spend. If $50,000 is what you spend per year, you can simply multiply by 25 to know what your financial independence number is. And I'll explain the relevance of these numbers quickly. So 50,000 is what you spend per year, right? The 25 you're multiplying it with is to get a number such that when you put it into, again, a safe asset, there are some investments that will continue to exist till the end of time, like bonds, because corporate, both organizations and government will continue to borrow money. Like things like GICs and term deposits, they will continue to exist because there are some safe assets that the bank would need. But they are usually low interest rate assets. That's why they are term safe. So they'll give you low interest, but at the same time, they won't overexpose your money. GIC is guaranteed investment certificate. It simply means that if I put in $5 in the bank today, I can go and sleep and close my two eyes. If I come back at the end of 1 year, if 1 year is our agreement, I'm going to collect my $5 and I'm also going to collect the interest that is promised. So if they promise me 2%, I know that 2% is not much, oh, but there won't be any story. At the end of that 1 year, I'll get my $5 and I'll get 2% on top of my $5. Guaranteed. That's why it's called guaranteed investment certificate. But depending on the state of the economy, the interest rate on it might be quite low. So right now it's at, I believe, maybe around 3.5%, if not lower than that. As of last year, I was still able to get some for like 5%. Again, several things affect it, inflation, interest rate, and all that. We'll skip those parts. But of course, we can extend this conversation at any point in time. So that's how to know what your number is. Know how much you're spending per month. Multiply by 12, you get the amount per year. Multiply by 25, you get the entire amount. Then if you get that 1.25 million or whatever your final number is, if you put it in an investment like GIC or any other safe investment that is giving you something small like 4%, then you're able to get back 50,000 every year to spend. So 1.25 stays in the bank in GICs, for example. GIC is not the only thing, but that's just an example. So it makes you $50,000 in year one. You collect $50,000, you spend it, use it to settle your expenses. Year two, you go back to your 1.25 million, collect another 50K, use it to settle all your expenses. And you can live like that forever. Then at the end of time, you can decide to collect your 1.25 million and blow it, or you can pass it on as a legacy to your children. So that's your number, your financial independence number, or your need, basically. The second thing you need to know um, to win the game of money is time. Time is your best friend. So if you're going to invest, definitely the best time to invest is now. is like today, today, today. And here is the reason. We have two examples in here, two fictional characters. That is, we just assume their names. But I happen to know an Alex and a Buki anyways. So you have two people, Alex and Buki. One person decided to start investing today. And Alex, and that's Buki, right? Buki is the yellow lady at the back. So she starts investing today and she's investing just $1,000. $1,000 um every month for the next 25 years. But Alex decides, you know what, I'm going to wait till 10 years time when I'm maybe 35 because I'm too young right now. So Alex decides to wait for 10 years and then starts contributing $1,000 from that point in time. Now, after 25 years from day zero, which is today, Alex that started late would have aggregated $180,000. Bookie that started and invested throughout, she didn't even invest, she saved, just put the money away in savings account or even in, there are some Sharia accounts that don't earn interest, right? I don't want interest, I just want to save my money. If you put it in there, then definitely you have Buki who started early will have $300,000. Alex who started 10 years later would have $25,000. It's expected. Somebody started late. Now, if you extend that concept a little bit by investing, not just saving, you put it into something that will give you maybe 3%, 4%, whatever the interest rate is, the more important thing is time. Then later on, you'll find successively higher interest rates or better things to invest money in. The beautiful thing that happens is compound interest. So if you invest at 2%, 3%, 4%, whatever it is, for this example, I used 4%, which is pretty low and very realistic. So again, Bookie started early, invested, but every year she earns 4%. And Alex did not again start early and he started 10 years time, invested $1,000 for the rest of the period. What you would see as the difference is this inflection, meaning the person who starts early will earn way more money than the person who started late because of the cumulative effect of that interest rate. It's called compound interest rate, meaning I put in $1, the $1 earns 4 cents. That means next year I'll put in $1, 4 cents. It earns another 4 cents. Now it is $1, 8 cents. That's even linear. It actually grows geometrically. That is faster than what I just described. So that's the power of compound interest, putting in money, not just in a savings account, but into an investment account, even if it's a safe one that won't risk your money, but it's yielding something in trickles and you're consistent with it, you're going to make a whole lot of money. In this second example, you'll see that the difference is actually way more. The number for book you started early was 519, so about $520,000. While the other person made $249. So that's less than 50% of what the other person made, even though the time lapse between both of them was just exactly half. The other person made a premium of 2% on top of the 4% compounding that they already have. Forget about the specific numbers and the mathematics behind it. When you have time and you use a spreadsheet, you realize that it is consistently true. I've tried it so many times using simulating it on Excel spreadsheet. It is consistently true. So compound interest is something you don't want to joke around with. So instead of saving your money, the takeaway from this page is instead of saving your money, invest it, even if it's into something safe. And there are so many ways, once again, to do that. Of course, we can continue to engage and we can spend time to delve into so many options for you in there. For example, you can combine the power of tax-free savings account and GIC to make sure that you're not paying tax, and it is, of course, very legal. Government allows you to, and then your money is compounding and you're keeping everything that your money earns, and the risk is zero. So we move on quickly. Apart from time, the other thing that you need to consider for sure is the investment type. I'll just summarize this. Basically, there are three things when you want to select any type of investment, three major things: liquidity, safety, return. Liquidity means how soon do I want this money? Or if I need it anytime, how quickly can I get my money? So if that is your priority, you want to make sure that you're not investing into things like real estate, because real estate takes time to even buy it. You do all that closing exercise and everything. Then to sell it, you go through another process. If you need your money in a week's time or in 1 month's time to maybe conduct a wedding, don't put it in real estate because it doesn't move that quickly. There are so many other things that are not as liquid, right? But you get the idea. Liquidity means how quickly I can access my money. The other thing you should consider to determine at the end of the day, what should I invest my money in is return. So return is the rate. Is it 4% that is going to give me or 3% or whatever the rate is? The last one is safety, which again is usually just a mirage. It's a feeling. So you might feel, you know what, I don't want to touch any kind of stocks, ETFs, anything because I hear that it is way too risky. So you decide I'll just put my money in a piggy bank. Your money will be wasting value in there, and I'll explain in a little bit. So safety would make you pick things that are not as risky. So you might be doing just purely GICs or treasury bonds. Treasury bonds will be when you want to deal with the government. So you can loan them some of your money and they'll pay you interest. The BOC, Bank of Canada, can help you sort some assets like that. So these are the three main requirements. Now, if you want to find a sweet spot of all these three, you'll start talking about diversification. And again, there's a whole lot of things you can do to diversify your investments. S&P 500, a basket of different types of asset class, so many gymnastics that you can do in that regard. But the takeaway from the slide is there are three main things you should consider when you're choosing any kind of investment, even to start up a business. If you are not a person that wants to take risk, don't touch startup businesses like Skip the Dishes wants to set up another restaurant, then you're putting your money in there. You can lose 100% of your money. So that starts to inform what you are going to put your money into. When you understand beyond your need or the amounts that you actually need, that final figure, you need to understand what kind of investment suits you based on your liquidity when you need to access the money, your return that makes sense to you, then your safety. Um, Again, there are other things like inflation. Now, I keep calling safety a mirage because when you keep your money and you don't invest it, it will depreciate in value. And the best way to demonstrate this to us will be to show you the Bank of Canada website and show you exactly what inflation means. In 1914, $100 in 1914, by today, how much do you think it's going to be? You can put it in the chat or in the word cloud within like 15 seconds. I just want us to guess. If I had $100 in my pocket in 1914, that's during the World War One. By today, how much will that $100 be worth? Can I see the chat? I can't see the chat. Can I see the word cloud? I don't see any numbers in the word cloud. I hope I'm not alone in class this time. Is anybody still there?
There's some answers on the
On the chat.
chat. Yeah.
Thank you. Okay, $31, $100,000. I think that should be quite close. All right, let me quickly reveal to my $20. Okay, let me quickly reveal it to us. Where is it? Where is it? Where is it? Okay, where's my slide? Uh, okay. All right. So basically, the way they presented it is in the reverse order. So if you have $100, or if you have if you have $100 as at then in 1914, what $100 will buy in 1914? You'll use $2,688 to buy it today. So let's imagine that in what do you call it? In 1914, you could have used $1,000 to buy what's like 25 now. To buy like an iPhone, if iPhones existed as at then, you could have bought it for $100. If you want to buy the same exact with the same specifications today, you are going to spend 20, I think this is 26, yeah, 26 times more money to buy the same thing as at today. Now, this looks like this mathematics is not really mathing that much. So let's use something very close to us, 2020. And I intentionally use 2020 because it captured the pandemic. 2020. So between 2020 and 2025, the money that you have in your pocket has depreciated by 17.91% within 5 years. So if you're keeping it just somewhere because you don't want to spend it, instead of being able to buy what that $100 will buy, now when you bring out that $100, you won't be able to use it to buy it again because that thing will now be worth $117. So your money would have lost value roughly up to this $17.91. So that's basically what it means. So your money is constantly losing value when you keep it. That's the point. Because when you go forward in time, those things would have become more expensive. And that way it's easy for you to understand inflation. Inflation is a price increase over time. So whatever you're able to buy today, by tomorrow, the thing would most likely have shifted. The reason is because the benchmark inflation, that is the balancing inflation that the government maintains, is about 2%, meaning the economy will continue to support the increase of prices. It is very intentional. There are some economies that have almost zero inflation, and it is very intentional for them as well. But we are in Canada. Canada's benchmark inflation is 2%, meaning by fire by force, everything will continue to be more expensive over time. So quickly, let's go back to wrap up our slides and take the questions. That's inflation for you. It tracks about the way to measure it is by your consumer price index. It manages about 700 goods and services. Because of our time, I won't go deeply into that. But basically, inflation is a key part of the economy, and it makes all your money depreciate in value to buy less and less into the future. How do you fight inflation? Invest in equities. So equities appreciate over time, like I described. Producers will continue to perform. All the shares that you invest in them will also continue to increase in value. Then you apply dollar cost averaging. That grammar simply means that you are consistently saving, like bookie. You're putting away, if it's $20 steady per day, you don't fail in that $20, and you're putting it into an investment directly so that it's earning that, even if it's 2%, the compounding effect over time will ensure that you grow something very significant. But the discipline to consistently put money into investments is what you mean by dollar cost averaging. If you do that, because it is compounding, then it is going to grow faster than inflation on the average over time. Then, of course, you track your expenses and don't spend needlessly. If there are major purchases that you should make, you don't make them when everything is very expensive. If it's a supplier's market in the real estate, you'll be paying maybe $100,000 or $200,000 above asking just because there's a bidding war. It's unnecessary. Then, of course, pay off all your debts as quickly as you can. If you have debts of 29% and it seems to be going, as much as possible, pay up all those big rate debts before you touch all the tiny ones. The last one, I believe, is taxes. Because of our time, I'll just summarize. I know we know most of the tax regimes, but there are different types of taxes, and we don't pay the same taxes at all. It is possible for me to pay zero taxes, and the easiest way for me to actually do it is own a business, be a producer. I can pay zero, and not only just pay zero, I can bank if there's any loss within the system for the entity. I don't run losses. I can bank those losses, and if there are profits in future years, I'll net the losses against those profits, meaning I reinvest all my money into my business and the government gets zero out of it. The government is happy to do that because I continue to create opportunities within the economy. I'm increasing GDP, I'm providing jobs. So the government is very happy. But interestingly, I also continue to own a bigger and a bigger share of the national pie or the economic pie. So that's taxes. And then, of course, in conclusion, what exactly can we do? There's tariff, there's inflation, there's interest rates. Number one thing to do is just save up as much as you can first. And the reason why you save first is to make sure that whatever happens, God forbid anybody loses their job, the first thing you want to do is to be able to survive. So you need to have something called an emergency fund, exactly as the name implies. In case something happens, something you can quickly fall back on. Then as quickly as possible, you want to become a producer so that you can have more say, more effect, more impact, more capacity to earn money and generate value within the economy. then of course you can make money like a bank. There are so many strategies to do it. Individuals can actually, it's not complicated, trust me. So we can continue to carry on these conversations, and of course I can give you several scenarios on how even I do some of these things. Then you know your numbers. We talked about how to calculate FIN earlier on. Then when is the best time to start both saving and investing? The best time is today. If you line activities or major activities up in a spectrum, that is what should come first, what should come next, and all that, the very first thing that should come is for you to earn money, like increase your skills, get a good job, start a side hustle, make money first. Once you start making the money, then you save up that thing that we call emergency funds in case something unexpected happens. Then the next step will be to start investing some of the money now, because you now have a buffer. That is, you have something that will absorb the shock if something unexpected should happen. Then you start investing as quickly as you can. Then at that point, you can decide to flex a little bit. But even by the time you start spending, my biggest advice will be for you to spend on assets. That is, your spending your money on things that can generate more and more money, like the producers, so that you continue to expand the amount of value you have within the economy. So that's all I have for today. Do you have any questions? I'll go back to the word cloud as well to make sure that we satisfy all our requirements. Do we have any questions? Who has access to the chat? Let me see if I can call up the chat if there are any questions in the chat. Do we have any questions? I see investments. I'm driving, building wealth through investments. This is what I'm looking at too. Building wealth with stress without, how can I become a producer? Absolutely. We can book this session with you, Adeolu, for sure. And I have my details on the screen, so you can also take a screenshot of this. You can reach me by my phone number, email, and that's our website. But of course, you can send me a message either on WhatsApp or regular text message on my number, and we can book a session. So we'll talk after. I know we have a meeting, Adeolu, after this meeting. So how to become a producer, we'll talk about that. Kindly share the previous slide again. Which one is the previous slide, Maze B? Let me know and I'll do that. All these amounts, do calculation for the Nigerian economy. Okay, I'll do that, but let me not hold everybody down. No, voila, we can see. And I can definitely draw up the scenarios for you. Kindly share the slide on that calculating how much one is. Okay, okay. Oh, fine. I can do that as well. So please, do we have any questions? Questions. I love questions, feedback. Let me know, let me know, let me know. Was this valuable for everyone? What's the feedback on how to calculate your needs? That's the calculation. Questions, please. I hope this was impactful for everyone. Questions.
Is it possible to group this, this topics, say investment and then have sessions specifically for this topic so that it's kind of deeper, because it's like you touched on everything. So is it possible to have these interest points or interest area and then maybe group the ones that are similar and then have workshops on those topics?
Absolutely, absolutely. I can do that. I can do that. So we'll find a way to aggregate the contacts of everybody online right now so that we can see who's interested in what. And I can always spend more time on any of the things that I've shared. Just to do a quick check, if we fulfilled all the requirements on the screen, we talked about how to build wealth through investments, and that's where we talked about compound interest. We talked about how to pick your type of investments. We talked about how inflation impacts on it and how you can hedge your investments. I know that I was quite fast, but trust me, I can always share all these things with you and answer all your questions on it as to the best of my abilities. That how to make extra income, plenty ways. Definitely. Whoever dropped that should let me know. Please, you can send me a message and I will definitely engage you on it. Do we have any questions? Questions.
Yeah, I have a question. I'm raising up my hand.
Oh, sorry, I didn't see it. Please speak.
No problem. Okay. I just want to ask now, well, based on your experience, although I know it might also not be something you can just go over now.
Okay.
Talking about investments,
Okay.
we have different, let me call it programs that the Canadian government has given us opportunity to do.
Yeah.
We have tax-free savings accounts, we have RRSP.
Yeah.
For those that have not bought a first home, they can leverage on the first home savings account. But
Yes.
I want to look at it. Your own advice when it comes to RRSP, does it
Yes.
make sense to have it with bank or financial is other financial institution apart from bank? And that one. Secondly, which one will you advise? Do I get financial managers or advice, or should I call them advisors to manage my investment, or is it something I can do by myself?
Okay. So thank you very much. Those are very salient questions. And if we had time, I probably would have touched on some of them. So yes, number one, RRSP. I know we are going to schedule a session we talked earlier today, so definitely I'll go deeper into it. But just for the benefit of everybody, RSP is one vehicle that I reluctantly propose or recommend for so many reasons. One of the big issues I have with it is RRSP is Registered Retirement Savings Plan. It's one of the accounts or investment vehicles provided by the Canadian government for you to be able to save towards your retirement, and it is intentional. Now, issue I have with it is you will not pay taxes today, but you will pay tax tomorrow or in the future when you are retired. For some of us, we intend to build businesses, build empires, set up, a lot of stuff that will be bringing money for us. We want to buy properties and all that. If your income increases, your tax will increase. So you're saving tax at the rate of 25% today, but by that time now, you're a big man. Your income per year is like maybe $2 million. You are going to be paying taxes at that marginal tax rate. When you want to now collect the money that you saved during your hustling days, they will take tax rate as at that time from you. So you saved 25%, you're going to be paying maybe 56% at that point in time. So you're paying way more than you saved at this point. And because it is percent, it is going to cut into your money like in a very, very, very painful proportional way. So 56% is as heavy on $1 as it is as heavy on $1 million. So that's the issue I have with RRSP. If you decide that you are not going to work at all during your retirement, then of course your tax brackets will be low. You can tap into those monies and your tax rate would also be low at the same time. Now, should you open it with a financial institution or somebody that will manage it for you? It depends. If somebody is managing it for you, they will most likely ask you to pay something called MER, management expense ratio, or fees. So those fees makes it a little bit more expensive, but you can manage it yourself as well. Now, it is not an either or question. It is which one do I want? If you want both of them, you can, again, remember that diversification that we said. You can decide to have some in there, some in there. Now, the question will now be what proportion? If I have $10, do I want to put $7 here, $3 there? And why am I splitting it in that proportion? So you can do both. You can have 20 RRSP accounts. The government has no issue with it. The only issue they have is when we pull all your funds together, it must not be more than your contribution room. That is where the problem will start if you flout that rule. So you can do a whole lot of things with it. It's just to know what's the rate of return. Does it now make sense for you to give it to somebody to manage it or invest it yourself? Again, it depends. If you know what you're doing, you can do it yourself. If you know that you don't have a clue and you don't have the time to spend, you can give it to someone else. But the thing I would like to call out is there's no guarantee that somebody is monitoring it for you. They are going to make more money than either you managing it yourself or investing into a diversified portfolio by yourself. And here's what I mean by diversified. Instead of me deciding to give my money to somebody that says I should come and buy mutual funds and they'll manage it, I can buy S&P 500 indexed funds. S&P 500 means a bag of a lot of company stocks put together and is diversified to like 504 organizations. I'll make money. Like it has been proven for over 151 years. 151. They've been constantly making money on S&P 500. On the average, I mean, there are bad years, there are good years, but on the average, in the long term, you make money. And then the analysis continues to compare that one that we just put everything together. I'm consistently putting money using dollar cost averaging. Like I said, I make money on the average of about maybe 6% or 10%. If I give it to somebody to manage it, how many times out of, say, 10 times will they be able to beat that performance of the one that nobody is helping me to manage? They are not able to beat it they are not able to perform more than that average. So actively managed funds are not better performed than a diversified, maybe S&P 500 or something that is indexed. Indexed means it's tied to the average performance of several other things. So those are the things to consider. You are not necessarily going to get a better rate, but you need to study each option and decide, do you want to do either or do you want to do both, and why? Once you figure out the why you're doing it and you get all the information, then of course you can proceed. And we can dissect that further. You can give me more details on what you're considering, and I'll give you specific advice on it. Was I able to answer
Another
your
hand
question?
up. There's another hand up.
Hey, Miss B, please go on. I'm sorry, quick one. Mr. Gwenga, was I able to answer your question? Is he
Yeah,
still
that's
here?
okay. Good,
Okay.
good. Yeah, thanks.
All right. Miss B, I can hear you.
Yeah, good evening.
Good
Thanks for the
evening, ma.
presentation. Yeah, I just want to find out now. We've heard a couple of times where they say, oh, financial advisors say, oh, insurance is like a driver for investing. For instance, universal life insurance and all of those things. What's your take on that?
Insurance is independent from investing. Investing is just you want to make money. Insurance is you want to secure the money. You want to make sure you don't lose the money. So one is conservative, the other one is aggressive and bold. They can be hyphenated, that is, they can work hand in hand. You can have an hybrid. For example, universal life insurance policies have both investment aspects and insurance aspects. So you can definitely do that. I know we're past 6 o'clock. I'm still answering the question, but if you want to leave, you can drop your details as well. And of course, we'll carry you along in the subsequent sessions. And you have my details. You can always reach out to me. So I was saying insurance can stand on its own, apart from investment. You can take a screenshot of my details if you want to contact me, and you can hyphenate them. You can combine both insurance and investment. So there's no like one has to exist for the other one to also thrive. It's not true. You can do either or you can again do both of them together, or you can do both of them separately. You're doing both of them, but you're doing both of it so that I know what is insurance, I know what is investment. Or you can decide, you know what, I'll put them together because they can benefit from each other's pros and minimize each other's risk. So it depends on what you really want to achieve with both of them. So one does not drive the other. They are independent. Did I answer your question, Ms. B?
Yes, you did. Thank you.
You're very welcome. Any other questions? Thank you so much.
Sorry, in the
Yeah.
chat there are two. Well, I'm going to read. One says, "Would you Titia Lighton says, would you like a seminar on becoming? Maybe she wants you to do a seminar on becoming producer and making money like a bank. I'm not sure what that question.
Yeah, absolutely. So I interpret that question to mean, should we do another seminar to focus on how to be a producer and make money like a bank? So we can split the workshops into two or put the two together, but focusing on how people can become a producer and also make money as a bank. So she's asking for a workshop to attend to that, right? Is she still on the call? So yes, the answer is yes. We can definitely get that done. Answer is capital YES. Yes.
The last one is, where can one invest money in Canada?
Plenty places. Plenty. So some of them we've talked about. You have something called registered accounts. Registered accounts simply means CRA, the government of Canada, provides those accounts for you to use in order to get tax benefits from it. If you invest into any other place, they want to collect tax from you. But if you put your money into those vehicles, you get some tax advantages. Now, the next step will now be for you to understand what kind of tax advantages you get from each type of account, because they all work very differently. So that is a kind of investment, and you can get different rates from them. I tell people that the cheapest thing you can use your money for, if you're eligible for it, is to put it in FHSA. And when I run the math for you, you will be amazed on how much money you're getting on your funds within your FHSA. It's huge. It makes absolute sense. In fact, it's as high as whatever your marginal tax rate is. So if you're currently paying the government 25%, you can make up to 25% on whatever you put into your FHSA, theoretically. And I know everybody on the call will agree with me. If anything can give, if any kind of investment can give you 25%, of course, that investment is not a small child investment now. It's a big deal. So yeah, so you have registered accounts. Then of course you can do equities. Equities simply means stocks and every other risk balanced assets on the stock market. So you have options, futures, stocks, ETFs, index funds, plenty things on the stock market. Then you can invest in real estate for sure if you understand it well enough. And then, like we were talking about, how you make a choice on what type of investment to pick. If you are looking for liquidity, it is not real estate. Unless you are defining your liquidity as money that you will want to pull out in maybe 3 years, 5 years, 10 years. So you would have to figure out all those steps that I highlighted. Know the amount of the need. What's the number? Define that number. Then, of course, what kind of investment suits you as an individual based on those 3 items: liquidity, safety, and return. Then you can now get into how much interest rate do I want, what markets, what's my risk avatar, risk profile, plenty other things like that. But those are the 2 places to start. Then once you do those 2 exercises, it's easy for you to see that this investment is not suited for me. That one, oh, okay, I'll consider it. I'll put it here. Let me look for other options so that I have 3 options to pick from. So there are so many things. You can invest into a startup business. At some point, I was pulling money together with friends to buy into real estate. We could invest into startups. I'm considering developing apps. Like, there's no limit to it. Once you have, and that's why it spells out the spectrum. You earn money, you save money, you invest money, then you spend money. So as long as you have that buffer and you've gotten into investing money, you can always continue turning it around and diversifying it into different places. Take it from a registered account, put it into real estate. Take it as rental income from real estate, put it into equities. Take it away from equities, or take part of the equities, put it into a startup. So now you know that at least all those 4 things cannot fail at the same time. Real estate has nothing to do with the US or European stock market that you invested in. So you keep making sure that you have some, like insulation between your asset classes. So yeah, there are so many types. So we just need to make sure that we're going through the process. We're not jumping the process, and I'm just giving you some blanket options. Not all investments are good for everyone. The investments I put my money into, I will tell people not to put their money into some of them, because if you're not there, you're not there. If you can't take risk like I do, then don't do it. Otherwise, you won't be able to sleep at night. So any other, I hope I answered your question. So we just need to go through the process. You have my details. Let's book a session. I could also share, let me quickly share this as a last item. Thank you for waiting on to this time. I'll share my details in the chat so that you can book a session with me. I'll be glad if you do that so we can take this conversation forward. Where is my chat? Okay, so no, to everyone. All right, so you have my link to my personal calendar. You can book a session with me. It's free. It's 100% free. I enjoy this, like you probably must have noticed. I love numbers and finance and accounts and making money. Just, to be able to do more better things with money and, impact more lives and be free generally to do whatever you want to do. So it's always an exciting time talking about money. Just book a session with me and we can take this forward for sure. You'll see my calendar, just check availability, book any of the times. You can see it on the screen, and we'll be good to go. Thank you so much. Any other question? Can you still all see my screen? Did I answer all the questions? Any question? I think we did all this. We are now, even if it's a little bit more financially literate, we know about several investments, and then we're better off. Thank you so much. Thank you, everyone. If there are no other questions, please send me direct messages. You still have my details. Take a screenshot. It's on there. Thank you. Thank you, Maze B. Thank you, Adeolu. Thank you, Dio. Thank you, Folakemi. Thank you, Folayemi. Thank you, Sagbenga. Thank you, Mrs. Temi Tokwe. Mrs. Tosin. I don't see if Tosin Nasiru is a Mrs. or a Mr. Thank you, Mrs. Zainab. It's always an exciting time talking to you all. Thank you. And see you at the next session. Of course, definitely. I want to make this into a series so that we continue to learn together and I show you case studies. You see live accounts and see what's going on in there, how money is being made in real time. And, just get excited about it and do some of these things for yourself. That's what would really make it worth my while if you're able to start making money. So let's get you there quickly. Thank you.
Thank you, Joseph. You actually did a very great one. It's quite insightful. Thank you. Well
Thank you
done.
very much. Thank you. Thank you for attending. Thank you very much.
Thank you.
Thank you. So you can take my beautiful picture over there, mainly because you want the details. So those are my details. I'll be expecting your calls. Then in the chat, you can book a session with me as well. Thank you so much. See you at the next workshop. Thank you. Thank you.
All right, thank you.
Yes,
Have a good
sir.
weekend.
Yes, sir. I'll see most of you behind the camera. Thank you very much.
Thank you. Bye bye.
Thank you. Thank you very much. I appreciate you coming. Thank you. Mr. Falayemi, are you still there?
Thank you very much, sir.
Oh, Mrs. Falayemi.
Thank you.
Thank you so much for coming. And of course, let's keep the conversation on.
Okay.
I'm willing to answer all your questions. You have
All
my
right.
details, right?
Yes, I do.
Perfect. Perfect. Thank you very much. Enjoy the rest of your weekend.
You
Send me well to
too.
the family. Yeah.
All right, bye.
Bye.